Real estate has long been one of the most popular ways to build wealth and achieve financial independence. It's a tangible asset, often appreciated over time, and provides opportunities for both long-term growth and income. Whether you're a first-time investor or considering expanding your portfolio, there are many ways to approach real estate investing. The key is understanding the types of real estate investments, the risks and rewards, financing options, and how to make informed decisions. In this guide, we'll dive deep into the different types of real estate investments, their benefits and risks, financing strategies, key metrics, and tips on how to get started. Real estate investing can be broadly categorized into several types, each with its unique characteristics and appeal. Residential properties, single-family homes. These are standalone properties that can be rented out to tenants. They are typically less complex to manage than multifamily units, and tend to appreciate in value more predictably. Residential properties are often seen as a lower-risk entry point for new investors. Multifamily units, duplexes, triplexes, and apartment buildings fall into this category. While they can be more challenging to manage, multifamily properties provide the advantage of higher rental income and economies of scale in maintenance. Additionally, if one unit is vacant, the income from the other units can still help cover expenses. Vacation/short-term rentals. With the rise of platforms like Airbnb, investors can buy properties in desirable tourist areas and rent them out on a short-term basis. This type of rental has the potential for higher income, but it also carries additional risks, such as seasonal demand fluctuations, property maintenance costs, and legal challenges related to short-term rental regulations. Commercial properties, office buildings. These can range from small office spaces to large skyscrapers. Commercial properties can provide long-term, stable income from corporate tenants, but they often require larger upfront investments and are more sensitive to economic downturns and shifts in the business environment. Retail properties, shopping centers, malls, or standalone stores fall under this category. Retail properties can be lucrative when occupied by stable tenants, but e-commerce trends and economic fluctuations can affect demand for retail space. Industrial properties, warehouses, distribution centers, and manufacturing plants fall into this category. Industrial real estate has seen growth with the rise of e-commerce, and these types of properties tend to have long-term, stable leases with companies in the logistics and manufacturing sectors. Land investment. Land can be a speculative investment. Undeveloped land can be purchased and either held for appreciation or developed into residential or commercial properties. Land investment is often seen as a long-term strategy with lower ongoing maintenance costs, but it may take time to see returns and is subject to zoning, environmental, and market risk. Real estate investment trusts, REITs. REITs are a way to invest in real estate without directly owning property. They are companies that own, operate, or finance income-producing real estate. REITs can be traded on stock exchanges, which makes them more liquid than physical real estate. They offer exposure to a diverse portfolio of real estate assets and can be an attractive option for investors seeking passive income and diversification. Fix and flip. This strategy involves buying distressed properties at a lower price, renovating them, and selling them at a higher price for a profit. The fix and flip model requires a solid understanding of property values, renovation costs, and market demand. It can yield substantial profits in a relatively short period, but is riskier due to the uncertainty of renovation costs and market conditions. Cash flow. Real estate investments, particularly rental properties, can generate steady income through monthly rent payments. This cash flow can cover your mortgage and operating expenses, and any surplus can be reinvested or used as passive income. When done right, real estate can provide a reliable stream of cash over the long term. Appreciation. Real estate values tend to rise over time, although there can be cyclical fluctuations. This appreciation, particularly in growing or well-located areas, can build significant equity in your properties. Over the years, you can sell properties at a higher value than the initial purchase price. Tax benefits. One of the major draws of real estate is the tax advantages it offers. These include depreciation. Even though properties increase in value, the IRS allows you to deduct depreciation from rental income, effectively lowering your taxable income. Mortgage interest deduction. You can deduct the interest paid on your mortgage loan, which is often a large expense in the early years of ownership. Property tax deductions. Real estate investors can deduct property taxes from their rental income. These tax breaks can add up, helping increase your overall returns from real estate investing. Leverage real estate allows you to use leverage to amplify returns. This means you can purchase properties with a relatively small amount of your own money by taking out a mortgage or loan. When property values increase, your equity grows significantly because your return is based on the full value of the property, not just your initial investment. Tangible asset. Unlike stocks or bonds, real estate is a physical asset. This tangibility offers some protection against market volatility. Even if property values drop in the short term, the physical asset can be used for other purposes such as renting or selling, which may provide a more stable investment than more speculative assets. While real estate investing offers many benefits, it also involves risks that should be carefully considered. Market risk. Real estate markets are influenced by a variety of factors including interest rates, economic growth, and local conditions. During economic downturns, property values may drop, rents may decrease, and vacancies may increase. Understanding the market dynamics of your specific area is crucial to mitigating this risk. Liquidity risk. Real estate is a relatively illiquid asset. Selling a property can take months, especially in slower markets. Unlike stocks or bonds, you can't quickly sell part of your property to access cash. This is why it's important to have enough liquidity or cash savings to cover your expenses or emergencies while holding on to real estate. Management. Risk managing rental properties can be time-consuming. Tasks include dealing with tenants, handling maintenance and repairs, managing leases, and ensuring compliance with regulations. Many investors hire property managers to deal with these tasks, but property management costs can eat into profits. Interest rate risk. When interest rates rise, the cost of financing increases, which can reduce your cash flow or limit your ability to refinance at favorable terms. Higher rates may also reduce demand in the housing market, leading to lower property values. Unexpected costs. Unforeseen costs such as sudden repairs or long-term maintenance issues like roof replacement or plumbing problems can reduce the profitability of an investment. Proper due diligence and setting aside a reserve fund for emergencies can help mitigate these risks. Real estate typically requires a significant upfront investment, but there are several ways to finance property purchases. Traditional mortgages. Conventional mortgages are the most common form of financing. These loans typically require a down payment of 20% or more, though some government-backed loans like FHA loans may allow for smaller down payments. Interest rates and terms vary based on the type of mortgage and the borrower's creditworthiness. Hard money loans. Hard money loans are short-term loans provided by private lenders or investors, often used for fix and flip projects. They tend to have higher interest rates, often above 10%, but provide faster funding, making them suitable for investors needing quick capital. Private lending and partnerships. Private lending involves borrowing money from individual investors or groups. This can be beneficial for larger projects or when traditional financing is unavailable. Real estate partnerships involve pooling resources with other investors to share the risk and rewards of the investment. Real estate crowdfunding. Crowdfunding platforms allow you to invest small amounts of money into large real estate projects. This democratizes access to real estate and allows investors to diversify their portfolios without the need to own a property outright. Step 1. Research the market. Study the local real estate market. Understand the neighborhoods, property values, rental rates, vacancy rates, and future development plans. Tools like Zillow, Realtor.com, and local government websites can be useful in gathering data. Step 2. Define your investment goals. Determine whether you're looking for long-term appreciation, steady cash flow, or a quick profit from flipping properties. Understanding your goals will help guide your investment strategy. Step 3. Build a team of experts. A real estate agent, mortgage broker, attorney, accountant, and property manager can all help ensure a successful investment. A good team can provide critical insights and help you avoid mistakes. Step 4. Start small. If you're new to real estate, consider starting with a single-family rental property or a small multifamily building. As you gain experience and confidence, you can gradually expand your portfolio.
Thank you for watching. Kindly like, comment, and subscribe. Click on the notification bell so you can be alerted anytime a new video is uploaded. And please, don't forget, share and be a blessing to someone. God richly bless you. Shalom.